with, do we consider inventory and what gets counted as like equipment? So, like when you think of like fuel, that may be something that is necessary to complete a sale, like to travel or something like that.
It's not something, so you buy 10,000 gallons of jet fuel, whatever it is, okay? You're gonna use it up. Okay, it's a physical act, you're gonna use up. It's not gonna be a capital expenditure.
Right.
A capital expenditure is something that we're gonna see winds up being a net property, plant, and equipment, like buying a building. Anything that's that's gonna last for a long time, that's gonna be a capital expenditure, and you're gonna take off depreciation every year. Stuff like inventory, like a fuel or stuff, it's only in there for a short period of time. You buy it and you're gonna sell it.
And it's consumed.
Pardon?
And it's consumed versus
Yeah.
the building is
Yeah.
depreciated, but then it can be sold again.
Yeah. Does that make sense to you?
Yeah, I guess so.
I guess so. It's never a convincing. Yeah, Mark?
Yeah, a question with that is like, I mean, you have, on one hand, you have consumables, which are like gas, oil,
Yeah.
stuff that you buy and you use up and it's gone. On the other hand, you have like the actual airplane and so
Yeah.
on. But like, where do like, say, talk about the whole airlines, where do like engine parts go between that and so on? Because you use it for a time, but once you install it, it's there.
Yeah.
Like, there's some expensive parts in an engine and like the actual airplane engine. Like, well, where do you know the boundary between what's a consumable and what's a
Okay.
equipment?
And actually, let's put it this way. What you would prefer to do is anything that you expend, any expense that you make, you would prefer that you count it as an expense on your income statement now. Because by doing that, you reduce your taxes now. All right? And so there's an incentive for firms to sort of manipulate that and want to do it sooner is better than that. On the other hand, the one who's going to dictate what you can do is going to be the accountants and the government. Okay, they're going to determine how you can treat things, all right? So what you prefer, let me just a simple example, Mark. If you bought a new computer, okay, for yourself, and it costs $2,000, I'm just making up a number, okay? What you prefer to do is, I want to take that $2,000 from my income this year, okay? Because that will reduce if I can deduct $2,000, my tax rate is 20%, that will reduce my income by about $400 this year. Taxes I have to pay about $400. Oh, but the federal government comes along and says, that thing has a life of 5 years, so we're going to let you deduct $400 every year in depreciation. So you get the same effect, but if what you can do is do it now, Mark, you get the benefit now, versus having to depreciate it over time, where you get the same tax benefit, but it's spread out over time. And if there's anything in finance is true, is sooner is better. Getting it sooner is better. So there's this tension here. Most firms people would like to expense things now. Federal says, no, I want you to spread it out over time.
So what's the advantage of the government just spread
Pardon?
out? What would be the advantage for the government? More taxes now?
Yeah, if you pay,
No, but so what
okay,
you
if you pay more, if you pay less now, they get less now and they get more later. If you pay more now, then nothing. So sooner is better. From their point, they want you to take it later, and from your point of view, I want my tax benefit early. Does that make sense? So there's these tension points. It gets back to how much income can I count? Okay, and even to the point where sort of, at what point do I start writing off accounts receivable because of bad debt? Okay, and think also about inventory. Accountants value inventory at what you pay for it. Okay? It gets put into inventory for what you paid, but some of that stuff that sits in inventory actually could be worthless. And it's another one you'd have to write off, Mark, if you did it. All right? So, typically cash, accounts receivable, inventory. That's what we call current assets. Typical thing is current assets are things that you could probably liquidate within a year. Okay, in other words, there's sort of short-lived kinds of things. All right. Then you have net property, plant, and equipment. This is all the stuff where it's the buildings, it's the airplanes, Mark, and things like that where you're depreciating over time. Okay, that's your sort of investment in physical assets. And you add it all up, total assets. That's how much you have invested. All right. Yeah, Mark?
Another follow-up question on what depreciation. Say even an airplane and so on, when it's end of life, I mean, there's still some scrap value. What was that accounted for?
What's that?
So like when you have like an airplane and it's end of life and like 20 years later it's being decommissioned or whatever, it still has scrap value. It can still be sold off for some sort of value.
Yeah.
Is that accounted for during the actual depreciation? What they think they can scrap it for, or was that
Okay,
later by
let's
added on?
think about this. Think about this. Is suppose people do this now. Is that you buy a single-family house, and you rent it. Okay, you rent it. If you rent it and are collecting income, you can depreciate the house. So, but then when you turn around and you own it for 5 years and you sell the house, your gain on selling the house is going to be determined by, oh, what did you sell it for? Oh, original purchase price minus the depreciation you had over time. So you're sort of, that amount is going to be, we'll talk about that as the book value. It's the difference between the book value and what you sold it for is what your taxable gain is. Okay, so if you sell an airplane at the end of 20 years and you fully depreciate, it has zero book value, fully depreciate it down to zero, all of that sale price is a taxable gain. Government gets their stuff no matter what. It just may be a little bit different in time. Not the timing of what goes on, okay? And but this part of the things, you have all these rules. Any questions about assets? So this records like how much you have invested in assets to run the business. Yeah.
So
Okay?
just to clarify, I think I got it right. The net property, plant, and equipment is the depreciated value,
Yeah.
not what is worth minus what you owe on it.
No,
Because
no,
the
this
debt
is-
is considered somewhere else.
No, this is just what you paid for it, okay, minus the accumulated depreciation. That's it. And you never depreciate land. So if you buy something, land doesn't depreciate.
You don't have to appreciate it either, unless you
No,
sell it. to someone.
unless you sell it to somebody, and that, all right? So if you have something on the books that had 30 years, it's a 30-year life, and you may basically have a book value close to zero, it actually could be worth a lot. Because the accountants don't take into account what the market value is. And it's not about market value and what goes on, all right? Excuse me one second. Wearing a mask for me, my nose starts running. I don't have a cold. All right. So, let's look at liabilities and net worth. Is this helpful?
Yeah.
Does give you some framework about it. And you can see how different businesses, how they run their business is going to get reflected in this. All right, so let's go here. Cash necessary for operations, accounts receivable, what your customers owe you. This is just a good point, which is for a supermarket. Basically, people go into the supermarket, buy what they're going to get, pay cash. Right? They either use credit cards, or they pay cash, or nobody uses a check anymore. I can't remember the last time somebody wrote a check in a supermarket and do it. But that's, so there's no, their customers don't really owe them anything. For other businesses, it's standard practice that they give their customers 30 to 45 days to pay them when they buy stuff. The case we'll see this afternoon, that's exactly what kind of thing we're talking about. And if you, basically when you say accounts receivable, okay, those people don't pay you any interest. It just, you know, you get, the terms are, think of it as 30 days, 45 days, same as cash. No penalty as long as you pay within that 30 days or 45 days. All right? So, all right. So as I point out here, other business takes 30 to 45 days for a furniture dealer, with 30 days same as cash on December 31st. Accounts receivable will be roughly equal to the sales in December. Okay, that's all, they're all up to date. Inventory stuff available for sales. All right, let's look a little bit at the cash cycle. Now, the example I'm using here is a furniture store. Okay, furniture store. What they do is they buy a couch for $1,000, sits on the floor for 45 days. Somebody comes in and buys it for $1,000, but the customer has 30 days to pay. And so 30 days after they sell it, they receive the $1,100. So basically on this, if they pay $1,000 up front, they have to finance $1,000 for 75 days. Okay, so they have to wait 75 days to get their cash if they pay the $1,000 right up front. All right, so let's look at book value of assets. I want to emphasize, this is the total assets is the book value of assets. It may not have anything to do with what those assets are really worth. Does that make sense to you? A lot of stuff could have been in there for a long time and it doesn't reflect current. It just gets reported. All right. All right, where did the money come from? Let's look at that. Assets, liability, net worth. Here's liability, net worth. Notes payable to the bank. Those are loans from a bank that